All right. Good morning, everyone. Welcome to the last day of the Advanced Financial Management revision. I'm Paritosh Panchal, and I'm so happy that you all have been watching the older videos and have shared your comments and given feedback individually to me, have reached out to me directly. Um, so, based on certain feedback, we are going to make a small change in today's last session. Okay, instead of solving the entire paper, I'm going to take more time and solve only the first two questions. That is one question from section A and one question from section B. And the last question, which is on hedging, we have anyways in our previous two mocks, we have solved one question on interest rate hedging and one question on financial risk hedging. All right, so I think that is sufficient. And today we'll focus majorly on section A because I understand from the feedback given to me that there needs some practice in writing the report. Okay, so we'll be discussing the report part in more details today as well. So let's begin without further ado, right? So this is your your instruction screen. Okay, you can go through this when I'll share the paper with you. Okay, those of you who do not have it, you can just uh, write to us and then we'll reach out to you and share this sheet with you. Right, so section A, section B, 50 marks as discussed, and section B, another 50 marks, 25 marks each question. And section A, we need to write a report. So section A contains, now important, all right. Remember, 40 marks is the technical skills and 10 marks is the professional skills. Section A, question 1. The following exhibits available on the left-hand side of the screen provides information to the information relevant to the question. So on the left-hand side of the screen is your question. On the right-hand side will be your spreadsheet and your word processor. Actually, the tabs will be on the bottom left, but when you click on it, they will open up on your right-hand side. Okay, so you have four sections. Right, so first is Kingdom Company, then the takeover defense used by Kingdom Company, financial details relating to the cost of capital and bond information, and lastly, the employee remuneration. So depending on which question you are answering, different windows you can open. Now, so our first requirement is discuss the feasibility and effectiveness of defense strategies of selling off individual garden centers and enhance directors' remuneration. Okay, so certain defense strategy have been deployed. Let's see what they are, and then we need to discuss those strategies. Prepare a report for the board of directors of Kingdom Company, which estimates the company's cost of capital before the new bonds are issued. Then estimate, so we have to calculate the cost of new bonds. We have to estimate the market value and post-tax cost of debt of the new bonds. So we have to find the market value as well as the yield of the new bonds. And then estimate the revised cost of equity and revised cost of capital if the new bonds are issued. So now cost of equity revised. Okay, so here this is WACC. And then here this is cost of bonds after some issue. Then after the issue, what is the cost of equity? Discuss the impact on Kingdom's company's cost of capital and the reaction of equity and bondholders to the CEO's proposal. The discussion should include an explanation of any questions made in estimates B, subsection 1, 3, and above. Okay. So at the end, we have to write what impact or what would be the reaction of our existing equity holders and existing bond holders on whatever proposal the chief executive has. Now discuss the approach taken to employee remuneration by Kingdom's Northern region and the issue associated with it. So this seems to be from a different topic altogether, something relating to employee remunerations. Professional marks, 10 marks. Okay. So let's read. So what do we have to write? Firstly, we have to find cost of the overall WACC, then cost of debt, then cost of equity. This is post issue of new bonds, and then the impact or the reaction of equity and bond holders. Then we also have to discuss the feasibility. So all these things we will include in the report and discuss whether the defense strategy is good and how effective it would be, along with some remuneration, directors' remuneration being enhancing. So let's read the case. Kingdom Company is a nationwide chain of garden centers selling products such as plants, fertilizers, tools, and garden furniture. It has established 20 years ago by the current team of executive directors and achieved a listing on its local stock exchange 4 years ago. Since listing, the company has made consistent profits and has been able to increase its dividends each year. The executive director collectively own between 25% of issued share capital. The remaining shares are held by a number of investors, with none of them owning more than 10% of the issued share capital. Right? So this company is 20 years old, which means it's well-established company. Just 4 years ago, it got a listing in the stock market. And since then, it has been able to make consistent profits and is paying dividends to its shareholders regularly. So that's a good thing. Now, the executive directors collectively own 25%, and the remaining 75% is with the public at large. Right? And these are the same executive directors who had initially started the company. Right? Two of Kingdom's major competitors have been taken over in the last 2 years. Media coverage suggests that further takeover are possible. Potential acquirers include other chain of garden centers, property developers, and supermarket chains looking to diversify their business into the profitable garden center sector. As yet, no potential acquirer has approached Kingdom Company to buy the whole chain. Although Kingdom has had inquiries from other business wanting to purchase individual garden centers, Kingdom companies can sell a number of individual garden centers without threatening its continued existence. Right? So our competitors have been taken over, and there has been some media speculation that possibly even our company could be taken over. And though no takeover bids or no one has expressed interest, but there have been some inquiries from other businesses wanting to purchase some of our centers. Now we can sell individual garden centers without, selling off the entire company. So that's a possibility for us. Now, Kingdom executive directors remain committed to the business. They are fearful of a takeover, believing that new owners will want some or all of them to leave the company. They have therefore been considering possible defense against a takeover bid. Kingdom Company's chief executive has received two proposals from directors. Right? So the executive directors are a little concerned. They are scared that if they are taken over by another bigger firm, they may remove some of the executive directors, if not all. Okay, so they are a little concerned, and they are trying to explore what defense strategies they can deploy. Now, two proposals have been put forth by the directors. Number one is sell individual garden centers, which would be particularly attractive to purchasers. Disposal of these centers would make Kingdom Company overall a less attractive purchase, right? And pay. So option number one is we sell off certain garden centers, the prime most, which are very attractive for the purchasers. So sell these off, and that way we are ensuring our survival. Okay, but the crown jewels or the star garden centers will be sold off, right? And this will basically help making our company as a whole less attractive. Now, second option is pay the executive directors higher remuneration and change their contracts so that they would receive much higher compensation for loss of office if their contracts were terminated early. Second option is, since currently no bids have been given, from now only start paying the executive directors very well, okay, higher salaries basically. What that is going to ensure is that even if later they get removed, they are fairly compensated for it. So they are fearing that they would get uh, removed in the future. So from now only, they are getting good remunerations. So these are the two solutions given by the director. In fact, the first one is what is popularly known as poison pill strategy, wherein you consciously try to make the company less attractive um, by damaging yourself, like poison pill. You know, you are swallowing a poison pill and you are damaging yourself just to make yourself less attractive to other people, right? What else is written? Kingdom Company's chief executive believes, however, that any defense Kingdom Company adopts should also strengthen the company's future. She is therefore proposing to expand the company's current limited sales of camping products in its garden centers by establishing a chain of Kingdom outdoor shops selling camping, walking, and other outdoor equipment. The outdoor retail sector is competitive, but the chief executive believes that Kingdom Company will be successful. The establishment of the chain of outdoor shops would be funded solely by debt, the idea being that the changing Kingdom Company's finance structure by having significantly more debt would make it less attractive to buyers. Right? So the directors or the chief executive has said that we do not only want to make ourselves bad in front of the acquirers, okay? Because then the long-term sustainability, as in whether the company, see, till date, the company is doing great. It's making profits, it's giving dividends, but the moment it will sell off its big garden centers, which are bringing in the big money, the company will definitely become unattractive, but also to existing shareholders, and maybe their returns are compromised. So the chief executive does not want that to happen. Okay. They, she's of the opinion that whatever steps we take should also strengthen the company's future. So what she's proposing is uh, we should also venture out into a different business altogether, okay, which is something similar. So instead of we sell outdoor shops selling camping and walking and other outdoor equipments also along with our garden center business. Okay, so she is proposing to diversify into another business and make up for that loss. Now that business is a little what do you say, competitive. It's mentioned over here that it is competitive, but the management is fairly confident that they can do well in it. And they say that this new business will be funded by debt to make it further unattractive to acquirers. Because if there is a lot of debt on the books, then you know, the company would also have to acquire that debt, and that is making Kingdom Company all the more less attractive, right? So our first question, that is A, was to discuss the feasibility and effectiveness of the defense strategies of selling off individual garden and enhancing directors' remuneration. So we need to discuss. Now, whenever they say we need to discuss, you kind of like give the good points and the bad points. You have to give the holistic view of both. So, well, when the proposal is selling off certain garden centers, which are the most attractive ones, right, are most profitable ones possibly, If you're selling that off, yes, it most definitely is going to make us unattractive. All right. So if somebody is just interested in our best performing garden centers, then they'll just cherry pick those. Why buy the entire company, right? Just buy the best ones and leave the existing company as is. So the intention to protect the company is definitely going to be fulfilled, because we are going to be definitely unattractive to the acquirer, and the acquirer is also happy that they have purchased the best garden centers of us, right? So the strategy is good. It is also known as the poison pill strategy, wherein we are selling off our crown jewels in this particular case. Now, there are certain downsides also of it. See, when we sell off the companies or these specific garden centers, we are going to get huge cash flow. And what are we going to do with this surplus cash flow? That's a question mark. Because when the chief executive spoke about expanding, she spoke about expanding via debt. That means this surplus amount is still with the company. So any potential acquirer can see that so much surplus cash is available with this company, it may become attractive. So see, every decision one takes, taking decisions is not the most easiest thing to do. All right. There are pros and cons, there are benefits and costs attached to every decision. We just need to balance the two and see, ensure that the benefits outweigh the costs. So the benefits are that yes, we are going to become unattractive. And yes, there is a great probability due to that unattractiveness, we won't get acquired and our company can sustain over the long term. That's the benefit. The cost is that, not rather the cost, but the flip side is maybe we still would be attractive because we have so much cash surplus on us. Now, to solve that problem, what will we do with the cash? We can give it off as one-off dividend to the shareholders. And in that way, shareholders in the short term would be very happy that, oh, yes, our existing shareholders would be super happy. Okay, we got some extra dividend. All right. However, whatever future requirements may be, any other expansion plan, at that point of time, we may not have enough money on hand. All right. And in fact, it could also skew our debt to equity level and our financial risk will increase, because otherwise this money would have be resting in us reserves, which is a part of the equity block. Okay, financial risk would increase, our shareholders would get concerned. Okay, very less equity, so much debt. Will it be able to sustain in the long run? Because all of this you are doing to sustain in the long run. So if you keep the cash, you are still attractive to the acquirers. If you give away the cash as dividends, then still there could be a problem, okay, about the future, whether the future sales will be sufficient to support the extra debt that we are planning to raise and in future also. Okay. And if we invest into, so then we need to contemplate, can we use that surplus to invest into the new business? Okay, or any other more positive NPV projects. So this is like an holistic view of that one point. Secondly, pay the executive directors higher remuneration and change their contracts so they would receive more higher compensation for loss of office if their contracts were terminated early. Now, well, if the directors are paid higher remuneration, so what? Yes, they are receiving, but this is not really, you know, in line with the overall objective of shareholders' wealth maximization. The executive directors are not working anything extra, not doing anything extra. They are just being compensated for for a fear that may or may not materialize of them being removed from the company. All right, so it is not fair, or it is not in line. It is in the selfish motive of the executive directors that they have decided to pay themselves more. So this needs to be communicated to the shareholders firstly. Everything should be clearly in a transparent manner put forth to the shareholders, and the shareholders should decide on this. Because because ultimately, if you are paying executive directors more, it is basically taking away from one stakeholder, which is the shareholder, and paying the directors more. In fact, the last question spoke about um, employee remuneration. So there is some employee remuneration related issues which we are yet to read. When we read that, and we can add to this point. Okay. But there is some issue with employee remuneration. If employees are not happy and you're spending more on the top directors, why? Just because they are scared that they would be removed, so that they want extra compensation today, is not really fair on those people, right? And what if they are not removed? That's a possibility, right? It's not going to stop someone from buying that. Oh, the directors are paid a lot, so I won't buy the company. It's not going to deter a potential acquirer. Like, yeah, when you were selling out certain garden centers, it was becoming unattractive. But here, only one party is benefiting, that's the executive directors. And our main objective was to make ourselves unattractive, or to protect us from the takeover, is not being accomplished, because it's not going to protect anything. What if the new acquirer is willing to pay those high salaries to the continue with those directors and continue paying those high salaries? Then what? Or they will just buy out the director. They would give a very good compensation to the director and ask them to leave. A nice severance package could be offered to them. It's a possibility that, we don't want you anymore, but thank you for your services. Here's a great, nice package, and we'll just buy them out. That's a possibility. So the second method does not seem to have a lot of pros in its hand. Okay, there should be proper corporate governance. There should be non-executive directors also involved, and to help this decision taking. Non-executive directors combined with the shareholders, they should also have a say in this strategy. Okay, so all these things need to be considered. So we explained, or we answered section A of this question, right? With whatever information. So if you see, this was the exhibit number 2. So exhibit 1, if you see here, exhibit 1 is about the company. Exhibit 2 is about the takeover defense. Exhibit number 4 is about employee remuneration. Okay, so let's just read directly, shift to exhibit 4, so that we are done with all sort of theory questions. Kingdom Company's annual report contains a general commitment to act with social responsibility in line with society's expectation. It also commits to paying its staff fairly in accordance with their responsibilities, and state that their staff are vital to their success. So the annual general report, or the annual report, which is published once a year. Every company is to do it. Every listed company does it, and it's actually a public information. You can just take up your favorite company's annual report and read about it and get an idea how annual reports are. So, anyways, in that report, it is explicitly mentioned that we are committed to our social responsibility towards the society at large, and we are very thankful and appreciative of our staff, and we credit them with our success. Now, to try to improve the situation of low paid employees, the government has recommended a basic hourly wage as the minimum level employees should be paid. Now, they have just recommended, it's not a law. Okay, it's just like a guideline. Although this minimum is not legally enforceable. Okay, so it's just good practice. It's not legal, but it's good practice. It keeps you in the good eyes of the society, the minimum wage. A newspaper investigation has revealed that some of the staff in Kingdom Company's garden centers in the northern region of the country are paid up to 15% less per hour than recommended minimum wage. Most of these staffs are part-time staff working limited hours each week, right? So, unfortunately, our company is not meeting that criteria, and it has come out in the media, which has highlighted the fact that certain certain employees are being paid less, and how much less? By 15% than the minimum prescribed or recommended wage rate. And these are mostly part-time staff, okay, who are working for limited hours. The manager of Kingdom Northern Region Centers, when asked to comment, stated that Kingdom Company had obligation to its shareholders to control staff cost. Lower pay levels were necessary to differentiate between staff, ensuring that managers and staff with experience and expertise were appropriately rewarded. The managers commented that pay levels also reflect the lower commitment of Kingdom Company, which part-time staff made compared with full-time. Sorry. The manager commented that the pay levels also reflected that lower commitment to Kingdom Company, which part-time staff made compared to full-time staff. So when asked to comment, one of our executives mentioned that unfortunately, there is a conflict over here. Okay, so this is one stakeholders conflict area wherein the company or the manager is obliged to increase shareholders' wealth. And in order to achieve that, they need to control staff cost. Okay, so they are trying their best to reduce that staff cost. And how are they trying to do it? Well, they are very much appreciative of their full-time staff, and they feel that they should be very well and fairly be compensated. And at the expense of whom, unfortunately, it's the part-time worker. Okay. They also say that the low wage kind of reflects that these part-time workers are not committed because they are part-time. They are not committing their full hours. They are committing only a few hours to the company. So since they are committing less, they are being rewarded less. That is what the statement was made by one of our management. Now the question is, so this again conflicts with that high remuneration to the executive directors. Here we are trying to justify by saying that, oh, we are trying to control costs and therefore we are not paying our part-time employees. And at the same time, we have a proposal to increase salaries of of executive directors who are not really working extra. So how can we justify paying them extra? Especially when we have a problem with our existing employees not even being able to pay the minimum wage which is recommended by the government, though not legal. Okay. Now the question to us was, discuss the approach taken to the employee remuneration by Kingdom Northern Region and the issues associated with it. Okay, so the approach that we have is in order to increase or in order to fulfill or honor our obligation towards our shareholders, we are cutting employee costs. And which employee costs? Our part-time employee costs, because we feel that uh, they are not putting in hours, and we feel that our permanent employees who have been working with us over so many years and their expertise, they need to be fairly compensated. Okay, that's the entire approach, okay, or the defense used. However, the issue is, see, this all is going to not going to go well since the news has come in the media, and since more people, once the society gets aware of these this is discrimination at the end of the day. We are discriminating between our full-time employees and daily wage or part-time employees. Like full-time employees getting, say, $100 an hour, and part-time employees just getting, not even getting minimum wage. It's not fair. And the society is going to judge. And we will lose our goodwill and our statement that we are working for the society, towards the betterment of the society, we are committed to the societal welfare, then we just fall on our face on that statement, because we are not paying employees even minimum wage. All right, so it's not going to go well with the society at large. In fact, that could even impact our share prices. Okay, it's going to hamper our goodwill. They may boycott our products. We don't know what repercussion it could have, but that is an issue from the society standpoint. From the standpoint of the employee would feel demotivated, that they are not even paid minimum wage. They would look for jobs elsewhere. Okay. Even if they do not look for jobs elsewhere, they won't wholeheartedly work for the company, right? And if they leave the company, then it's what is going to happen? Obviously, we will. In fact, we are talking about expansion. For that new business, we may not get employees because employees do not want to work with the employer which is not paying its employees well, or has a history of not being good to their employees, right? So it may have impact on the prospective employees for our new business. It may impact our existing employees. It may impact the society at large and our goodwill. So these are the issues which are associated with this strategy that we have adopted. So we need to change that. All right. We cannot continue it this way. So you could discuss all these points in details. Now, coming to our main question, um, prepare a report for the board of directors. We have already discussed, so we need the costs before, after, okay, and the reaction of equity and bond holders on this whole thing, as in the whole expansion plan and funding it the way we have decided to fund it. That is via debt. Let's read. Um, Exhibit 1 and 2, we have done. Exhibit number 3. So Kingdom Company currently has 25 million shares, $1 a share in issue, with a current share price of $5.56 per share. It also helps. It also has 0.45 million 6.5% bonds in issue. Each 6.5% bond has a nominal value of $100 and is currently trading at $104 per $100. The premium on redemption of the bonds in 3 years' time is 2%. Based on the YTM approach, the average tax cost of the bonds is 4.1%. Okay, so from this first paragraph, we can find out the cost structure and calculate, the cost of equity, cost of debt. See, cost of debt is already given 4.1%. Cost of equity, um, share price is given. Okay, nothing about cost of equity is given over here, but we can calculate cost of debt for sure. It's already given. We have our market values for both equity as well as debt. Kingdom Company's quoted equity beta for its existing garden center business is 0.9. So with that, we can also find we have our basically equity beta. So we just need risk-free rate and our risk premium and calculate our cost of equity. Cost of equity can be calculated, cost of debt can be calculated, and our market value is also there. So we can also calculate WACC. So let's do that first. Okay. And then we will see what the new bonds are about. So let's answer subsection B, question 1. Estimate the company's cost of capital before the new bonds are issued. Okay. In fact, that could be our title for the appendix. You got to be smart that way. So appendix 1. right? Where we are estimating the cost of capital before the new bonds are issued. So it's made up of cost of equity, or rather cost of debt we'll write first because that's already given. So cost of debt, right? So over here, the yield to maturity approach. So now a lot of students get confused that when cost of debt is set, okay, they may use the coupon rate. 6.5% is the interest only, not the cost of debt. Keep that in mind. The yield will always be our cost. Why? Because yield is calculated on the market values and not the face value. 6.5% is going to be paid on the face value of $100. However, these bonds are not trading for $100, it is trading for $104,000 or $104. All right. So always remember that when they say cost of debt, and especially when we are looking at from the company's point of view, we always want our after tax cost of debt. Okay, so after tax cost of the bond is 4.1%. After tax cost of old bonds, or rather existing bonds, is 4.1%. Right? Let's just highlight this. Okay. And for WAC, we also need values. So value of the bonds, or market value, so the market value of the bond is 104. How many such bonds do we have? 0.45 million. Okay. So 104 into 0.45 million. So these many $1,000,000. This is the market value of the bonds, right? In fact, we could say number of bonds is 0.45 million. Okay, and market value per bond is $104. Okay, therefore, right, 46.8 million. You could write it in one line only, like how I initially wrote market value of bonds, and that's it. That would suffice in the exam. Then moving on to cost of equity. Okay. Firstly, we could write market value of equity. Okay, so what's the market value of equity? 25 million shares, $5.56 a share. Okay. Right. Number of equity shares issued are 25 million shares, and one share cost $5.56. Right. So the market value will be $139 million, the market capital or market value. Okay, now coming to cost of equity. Cost of equity is equal to risk-free rate plus beta equity into equity market risk premium. Right, that's our formula. So cost of equity will be, now what is our risk-free rate? Let's see where the risk-free rate is given. So I think risk-free rate of return is 4% and market premium is 9%. And beta is also given 0.9. This is existing business. We are currently estimating for existing business, so we can take that beta. So risk-free rate is equal to 4% plus equity beta of 0.9 into the market premium of 9% will give us 12.1%. So cost of equity is 12.1%. So we can find WACC this way. We can say our equity, our debt cost for equity is 12.1, for debt is 4.1%. Okay, then we have the market values. Market value for bonds is $46.8 million. And this one is $139 million. Okay. Let's put the denominations over here. Cost will be in percentage. This is dollar million. Okay. So total will be right. So our weight in percentage form. Okay. And then moving on to our WACC, which again is a percentage, will be weights into your cost. And then you add it up. So 6% will be our WACC. All right. Is this clear? Wait, let me just check this. Okay, 12.1% is our cost of equity. It is worth 46.8 million. Sorry. Oh, sorry. I mixed this up. Our equity is 139 million, whereas our debt is 46.8. Yeah, so 10% is our WACC. All right, that's our. So the beauty of self-referencing is even if you make a mistake somewhere and you rectify it, you need not redo the entire calculation since all cells are dependent on it. Right? Let's just check again. Equity 12.1%, 139, and 4.1%, 46.8. Yeah. Okay. In fact, we can just. So 75-25% is the current debt to equity, or 25-75 debt to equity. And our total WACC is 10%. So we can just write the company's cost of capital is equal to 10% or is equal to whatever this cell says. So we have answered the first part, okay, with the relevant appendix number to it. See, now understand all these calculations you will be doing on your spreadsheet, but the report you will be writing on your word processor. So on the spreadsheet, you firstly have to number the question. So it's question 1, subsection B, subsection 1. Okay. And then you have put the appendix also to it, or subsection 1, 2, 3. If you're doing all of them together, just write 1, 2, 3, so on and so forth. Right? Let's see our questions. Yeah, B1. So we have estimated the cost of capital before the new bonds are issued. Now, estimate the market value and post-tax costs of debt of the new bonds and estimate the revised cost of equity and revised cost of capital if the new bonds are issued. And discuss the impact on Kingdom's cost. Okay, so we'll do this later, but we have to calculate these three things. So first one we did. So these two, that is market value and post-tax cost of debt. So that is why it is important to read the question, because normally what the student, estimate the market value, done. And they will start estimating the market value and forget that they also have to calculate the post-tax cost of debt of the new bonds. So we need to calculate both, right? Now let's continue reading our question. Kingdom plans to issue 0.6 million, 7.5% new bonds, each with a nominal value of $100. Now these bonds will be redeemable in 4 years' time at a premium of 8%. The coupon on these bonds, so how long were our older bonds? So in issue, each bond has a nominal value trading the premium on redemption of the bonds in 3 years' time. Okay, so our previous bonds were 3 years. These new bonds are of 4 years, and premium of 8% on redemption. The coupon on these bonds will be payable on an annual basis. The bonds are anticipated to have a credit rating of BBB. The issue of the new 7.5% bonds will not affect the market value of Kingdom Company shares or existing 6.5% bonds. So they have explicitly mentioned that the new bonds are not going to affect the market value of our old bonds. Okay, so the pricing is not going to change. Now, so we can write this as an assumption. So we give so many assumptions in the report. So this is one of the assumption we can mention, that it is assumed that the issue of new 7.5% bonds will not affect the market value of Kingdom Company share or the existing 6.5% bonds. Okay. And you can also challenge that assumption, that though we have assumed this, but in reality, the moment you issue a 7.5% bond of the same company, it is going to have an impact on the 6 month. Why will the bond holders hold on to 6.5% when they can get 7.5% in the same company? They will sell off the old bonds and buy the new bonds. Correct? Interest rates and bond prices are inversely related. So you need to challenge this assumption, skepticism, to make aware to the examiner that yes, you do realize that we have assumed this, but in reality, there is going to be a repercussion on it. Okay. And since the market value will change, the YTMs would change, the cost of the bond would change. Okay. So yeah, this is the information. 0.6 million new bonds, 7.5%. It's BBB rated. Nothing about the premium is given, but nothing about the market value of the bond or the cost of the bond is given. The market value of the new bonds will be determined by using information relating to Kingpin company's credit rating and the four bonds which the government has issued to estimate Kingpin's company's yield curve. All the bonds are of the same risk class. Details of the bonds are as follows. Now, these are government issued bonds and they have these yields and are redeemable for 1 year bond, 2 year bond, 3 year bond, 4 year bond, so on and so forth. All right. Credit spreads shown in basis points are as follows. So triple B minus 1 year, 2 year, 3 year, 6 year. Right. So we have the spreads. So we are going to add the spreads to this because this is government bond, the most secure, but we are AAA minus rated. Okay. So we need to adjust it as per R. So this is the government yield curve. We need to find our yield curve. Once we find our yield curve, now using yield curve, we can value our bonds because that's what they have asked us to do. All right, so we can arrive at our bond prices that way. Kingdom plans to invest in non-current asset. Okay, so let's value the bonds. So we can just copy paste our appendix number from here as in the title. Estimate the market value and post-tax cost of new bonds. Okay. Right. Now we can just make the annual yield curve. We can just copy paste it. So this is the annual yield curve. Now we know that they are redeemable in 1 year, 2 year, 3 year, 4 year. Okay. Now we can just add to this our credit spread. Just for easy calculation, 3 and 4. And credit spreads are basically basis points. Okay. So our credit spreads are 56, 78, 106, and 135. Now you can do a copy paste also 56. I'll just write it manually 56, 78, 106, and 135. Okay, so our yield curve. So Kingdom Company's annual yield curve. This is triple B minus credit spreads. Okay, so then we just have to 4% plus 56 bips. So 56 bips basically means 56 divided by 100. sorry, into 100. No, 56. 56 is basically 0.56%. Wait, or we could just directly write it. This plus 0.56%. Okay. So actually, if we want to write it, we can do it as this plus 0.56 divided by, or this divided by, yeah. So anyways, we can just leave it like that. Now, these are our yield curve. So we can just title this. We are calculating our annual yield curve of Kingdom Company. Okay, this is the calculation that we are doing over here. And we found the annual yield. Now, using this annual yield, we can find the value of new bonds based on annual yield curve. Okay, this is the standard method that we use. That how do we value bonds on yield curve? We have to take the interest. So if we say, we can just take the cash flow. Cash flow will be in dollar terms. All right. So per, what's the coupon? 7.5%. Okay. So on 7.5% interest is paid. And at the very end, we are going to get a return of, or a premium of 8%. So that is $108 dollars is what we are going to get at the very end. Okay. So year one, $7.5. Year two also $7.5. Year three, $7.5. And in year four, we are going to have, now you need not write it as cash flow. You can just directly do the whole thing. So 7.5 plus 108. Okay, it's a 4-year bond. So this is how it's going to be. Right? Now, what we can do is equal to 7.5 into 1 plus the annual yield. Okay, close bracket, and raise to, or instead of into, we can just do, we are kind of like finding the present value. So divided by 1 plus r. So instead of 1 divided by into 1 divided by 1 plus r, we are just doing 1 divided by 1 plus r raised to the year. Okay, so this, right, plus, now in fact, what we can do is, just find it out over here. This into 1 plus plus r raised to n. Okay. Sum is all of this 109.9. So let's just, sorry. Okay. 109.9. So this is our dollar 109.92. This is per bond. Okay. Right. So very simple. So calculation basically becomes easier if you present it this way. Else you could write it in one line, how we have been, how it's shown in your notes. Okay, you can do it that way also, not an issue. So 109.92 is the bond value. Now, what is the market value? This is the market value also. Okay. Now the market value or total market value of the new bonds will be this into how many bonds were issued. Where did it go? 0.6 million. Okay, so into 0.6, or we could just say number of new bonds issued is equal to 0.6 million. So total market value of the new bond is 0.6 into per bond price, so 65 million. So we have highlighted what is the total market value of the new bonds, and we have calculated the cost of the new bonds. Sorry, this is before. All right, we don't have the cost, so we have to calculate the cost now. All right, what can be the cost of the new bond? So if you see, cost of the new bond is nothing but the IRR. You can just write years, year 0. It's a 4-year bond. So 1, 2, 3, 4. Okay, cash flow. Now in year 0, it'll be the market value. Okay, and then you're going to write all the interest. So it's $7.5. And lastly, it's going to be, okay. But remember, we do these post-tax. Okay, so in fact, we can't take these. Always remember when you are calculating YTMs, okay, from the company's point of view, we have to do it post-tax. So it'll be 7.5% into 100 into 1 minus T. What is the tax rate? 20 or 30%? 25%. Okay, so 5.625, 5.6. All right. And in last year, we are going to get a redemption of $108. So $108. Okay, because redemption. So now we just need to find the IRR of this. So YTM post tax is equal to IRR, all the cash flows. So it's 5%. Let's see if it's, yeah, 4.7%. Okay, clear? See, in order to find the cost of capital of any bond, we take the IRR of all cash flows. So we first listed down all the cash flows and then found the IRR. In the CP platform, we can use direct formulas for IRR, right? So yeah, we can explicitly mention that post-tax cost of debt of the new bonds are is equal to 4.7%. Okay, we can in fact even highlight this. So it's very well understood that, yeah, post-tax cost of bond is 4.7 million. Total market value is 65.95 and per bond value is 109.90. So whatever the appendix title is, all to both the market value as well as the post-tax cost, both are calculated. Over here also, cost of capital. So cost of capital is 10%. Just whack, right? So we have done that. Now next, what they have asked. Estimate the revised cost of equity and revised cost of capital if the new bonds are issued. Okay, so revised cost of equity. Okay, in fact, you can write these appendix also, you can just highlight them in a different color. So the examiner knows that where are the bifurcations happening. So this is the appendix 1 and this is appendix 2. This is appendix 3. So they need not scroll everything. So it's all about presentation. You are getting marks for it. So impress the examiner, make the examiner's life easier. All right. Now moving on to our cost of equity, cost of bond after the new issue. So yeah, Kingdom plans to invest $60 million in non-current assets for the outdoor shops. Working capital requirements can be ignored. So that is another assumption that we are making, that working capital requirements are ignored. Currently, Kingdom Company's non-current asset have a net book value of $150 million. It is assumed that the proportion of the book value of non-current assets which will be invested in outdoor shops and the garden centers will give a fair representation of the size of each business within Kingdom Company. The asset beta of similar business in outdoor retail sector is assumed to be 0.88. So see, this is a new business altogether. So we will have to calculate our new equity, okay, a new WACC, everything will be new, okay. Um, so now to find out our new equity, see the focus, the new business is just outdoor retail. So that beta is 0.88, but we are not doing only the new business. We are still continuing with our old business. Okay, so we have to do like a weighted average. All right, we already have the split in business. 60 million is new business and 150 million is old business. Okay, so non-current assets, investment in new NCA was, I think 150 million. 60 million. Okay, 60 million if 150 is old. $60 million. Investment in, or value of, you could say, old or existing 150 million cannot have a net book value, or rather net book value. Net book value of 150. So if you can get your proportions from here. So total NCA will be 210 million. All right. What else is given? It is assumed that the proportion of the book value of non-current assets will be invested in the outdoor shop, and the garden centers will give a fair representation of. So we can write that we are assuming it. Sorry, where is it? Asset beta of outdoor retail will be 0.88. Okay. Asset beta of retail, outdoor retail is 0.88. Okay. And equity beta, our old equity beta, we calculated was 0.9. Existing equity beta, okay, that is garden center beta, garden center is 0.9. Okay, now we have existing equity beta, so we need asset beta of garden center business. Okay, so we need the asset beta now. For that, we have to ungear. So 0.9 into value of debt. Uh, Asset beta is equal to equity beta plus, equity beta into value of equity. Wait, I'll just write the formula so that asset beta is equal to equity beta into value of equity divided by value of equity plus value of debt 1 minus t. Okay, this is the formula. So asset beta, if we have to take, is equity beta into value of equity. So what is our existing value of equity? We can just get all of those from here. Value of equity is 139. Okay, or over here we can get it from 139 divided by 139 plus 46 debt into 1 minus 0.25. Okay, let's put this whole thing in a bracket. Right, so asset beta will be 0.77, which is 0.72. Okay, now we have the asset beta of garden center business. We have the asset beta of outdoor retail. So what we can do is outdoor. Again, you need not present it this way. You can write it in one line only. Outdoor retail and then garden center business. So now we are going to have two business segments. Okay, the asset beta of both is 0.8 and 0.72. What is the weight? Or proportion? And these are the non-current assets. Proportion. You can call it weightages, whatever. Okay, so 0.76, right, will be our weighted average beta. Okay, or weighted average asset beta of Kingdom. This is after the new issue and everything. All right, the new business and all of that. Now, once we have once we have asset beta, so we can take the average asset beta and find out our beta equity. So beta equity. Now this same formula which is above, we need to rearrange it because we have asset beta. So beta equity will be asset beta into now our proportion of debt to equity. So if you see debt and equity, we can say how our capital is structured. We have more than one debt and equity now. Okay, as in more bonds have been issued. So let's just write that down so there is some clarity to that. Market value of equity is same. Okay, 139 million. Market value of existing bonds market value 6.8 and market value of new bonds issued. Okay, that also we have found out 65.95. Okay, so beta equity will be is equal to our asset beta into value of equity. Sorry, now the whole thing is getting inverted. So it is this plus these two. Okay. Whole thing is multiplied with 1 minus tax. Okay. Divided by your value of equity. So value of equity is this. Okay. So wait, I think I have made some calculation error because there's so many brackets. In fact, let's simplify it. So total MV of bonds. These are all in $1 million. Denomination is very important. Is equal to this into value of equity plus value of debt into 1 minus t. Okay, that's 0.25%, sorry, 25%. Okay, this is the numerator part divided by value of equity. Okay, so 1.29, sorry, 23. Okay, so 1.23 is our beta equity. Now we can use this to calculate our cost of equity. So cost of equity is equal to risk-free rate. So risk-free rate was 4% plus our 1.23, the beta equity into market premium, which was 9%. Okay, so cost of equity is 15.07% or 15.1%, right? So now we can again make our format like before. Just copy paste this. The new bonds. So the cost will be, cost of equity is 15.1%. Okay. Old bond cost, well, they don't change, so we can take whatever we took initially, 4.1%. New bond we have calculated 4.7%. Okay. And then our market values. So this is equity, this is existing bond, and this is new bond. All right. This is the summation of everything. Okay. So 75.35. And our overall back, therefore, will be, wait, let me see if it's correctly calculating. So 15.2 into 75%. Okay. 4.1 into 25%. And 4.7 into taking all. Yeah. So our WACC will be 14%. Okay. Wait, just a moment. I'll just be back. Just a moment. Okay, I'm back. So this is 135%. I just saw it right now. Wait, we need to recalculate that. Some mistake. This divided by the total. Okay. Why is this coming still 135? Oh, okay. Right. This adds up to 100% now. Right. Yeah, 100%. Okay. So yeah, so the WACC is actually 10%. Now, what else do we have to find? A revised cost of equity and revised cost of capital if the new bonds are issued. So this is our revised cost of equity. So let's just write it down. Revised cost of equity is equal to 15.1%. And revised cost of capital as in WACC. If no bonds are issued, it will be 10.3%. Okay. So we calculated these. Now, what next do we have to calculate? Discuss the impact of, or okay, estimate the revised cost of capital and revised cost of capital if the new bonds are issued. Okay, this is done. Now, discuss the impact on Kingdom Company's cost of capital and the reaction of equity and bondholders to the chief executive. The discussion should include any explanation of any assumptions made in estimates above. Discuss the approach taken to employees' remuneration. So, yeah, we have to just do this much. Now, discuss the impact on Kingdom's company's cost of capital and the reaction of the equity shareholders. So what is the impact on the shareholder? Okay, wait, let's see if we have read everything. Read this, we have used this, used this, used this. Okay, before taking into consideration impact of this new investment, Kingdom's forecasted pre-tax earning for the company coming year is $24 million. It is estimated that the new investment will make a 10% pre-tax return and after-tax earnings will increase by $1.25 million. The corporate tax rate applicable to all companies is 25% per year. So we can also find out our revised uh, earnings. Okay, so before taking into consideration the impact of this new investment, Kingdom's forecast pre-tax earnings was $24 million. Okay, so before, so we can just write Appendix 4. I think that requirement is missing or something, but it was actually a requirement, or maybe in the new question it's not there. Okay, but anyways, uh, revised earnings forecast. Okay, so our forecast statement of profit loss for the coming years, coming year rather. Okay, now forecast after tax earnings. Okay, what are we going to do with pre-tax? We'll find out the after-tax only directly. So it was $24 million into 1 minus tax. Okay, so $18 million, or we can just write everything as $million. Okay, then what's the next information they have given? Yeah. It is estimated that the new investment will make a 10% pre-tax return and after-tax earnings will increase to 1.25. Okay, so will make 10% pre-tax return. So 10% returns on the, so after tax earnings will improve to 1.125 million. Okay, so just a moment, just a moment. Sorry about that. There was someone at the door. Okay. Uh, so we were reading. Yeah. So before taking into consideration the impact of this new investment, so yeah, we took the 24 million. Now they are saying that the new investment will make 10% pre-tax returns. Uh, the new investment will make a 10% pre-tax return, and after-tax earnings will increase by 1.125 million. So that is the increase, the overall increase. So 10% is the additional returns that we'll make on the new investment. So additional after-tax tax earnings due to new investment. Okay. Now, what we initially were making 60 million. Okay. See, if you see over here, wait, where is our return? Yeah. So we have an investment of 60 million. On that 60 million, we are making a return of 10%. Okay. So 60 million of the new investment, we are making a 10% return on it, and it will be 1 minus T. Right? So $5 million is what we are making on it. 60 into 10% into 1 minus T. Okay. Now, in order to earn this new, we also issued bond. So additional finance cost. Okay. How much financing we are doing? We have raised 60 million. Okay. And what is the interest that we are paying? The new bonds we are paying 7.5% coupon. Okay. Not yield, coupon 7.5% into 1 minus T. Right? Right. So what is our revised forecast? After tax earnings. So we initially were making 18. Additionally, we are doing 4.5 million. And there is an additional cost of 3.38 million. So 19.13. So if you see the change that we are making, okay, 1.13 or 1.125. This is the change or increase, you can say, in after tax earnings. All right. So revised earning forecast is this much. But anyways, this information, as I said, this was asked in the previous question. Okay, previous as in previous year's question. However, this time over here, because that time there were no 10 professional marks. Okay, so they had to give more marks. So in this one, I have revised it in a way that that question is not asked and the information is directly given in the question only. So here, where is it? Where did it go? Yeah, over here. Okay, so the information is directly given over here. Now we will go to the report making. I think we'll take a 5 minutes break, and then because we have been at it from almost 2 hours now. Wait, how many hours? 1 hour 40 minutes. So we'll take a break. See, I went slow this time because of the feedback which was shared by you all, that I was going a little fast since there was shortage of time and I was explaining everything. Okay, so we'll just be doing 2 questions, or maybe we'll just do section A and stop. Let's see, depending on how much time we have available. Okay, but I'll not rush. So yeah, we'll take a 5 minutes break and then come back to the report part of it. All right, welcome back. Sorry, my internet went off. I don't know. I'm getting a little. Fortunately, just when we took the break, it went. Uh, Anyways, let's see. Even yesterday, I was getting some trouble. So now we shall discuss how to write the report. So I've already written part of the report. So to the board of directors of Kingdom from the finance manager, subject is impact of proposed investment in outdoor shops. Before we write the report, let us just see what is asked to be discussed in the report. Prepare a report to the board where you are estimating the cost of capital. Okay, so we have to comment on, so there will be one paragraph on cost of capital. Okay, before the new bonds and after the new bonds. Okay, then and also the market value of debt and all those things needs to be highlighted in that paragraph. Estimate the revised cost of equity and the revised cost of capital after the new bonds, and discuss the impact of cost of capital and the reaction of equity and bond holders to the chief executive's proposal. That is the expansion proposal. The discussion should include explanation of any assumptions made in the estimates. Wait, let me see, it's coming. Yeah, coming properly. Uh, so we have to highlight all of these things, right? So firstly, our regular, how we address the whole letter. Okay, so the subject is impact of the proposed investment in outdoor shops or outdoor retail. Now I've just copy pasted it from the question. Introduction. This report indicates the impact of the proposed investment in outdoor shops and the consequent increase in debt finance. It also discusses the possible reaction of equity and bondholders to the proposal. Financial estimates provided in the appendix are used to support the discussion, and assumptions underlying the estimates are set out below. Okay, so a very brief introduction. Now, this I've written it in my own words. You can write it in your own words. You can copy paste it from the question, no problem. Like in the previous uh, reports, we have copy pasted it from the question. Okay, so anything. It's just giving a gist. What is this about? Without giving any details, you are just introducing what are we going to discuss in this report. Then we are going to discuss the cost of capital. Now, what is happening to the cost of capital? We before issue or before this whole expansion, our cost of capital was 10%, and now it has gone to 10.3%. Okay, so there is a little bit of, yeah, there seems to be a little bit. This is 10.3. This is how much? 10.1. Okay, so there is a small rise in the cost of or our weighted average cost of capital. Okay, despite debt increasing. So if you remember the traditional theory that if you increase more and more debt, initially the cheapness of debt is able to compensate for the rise in equity. So let's see, it was previously 12% and now it has risen to 15%. So the cheapness of debt, okay, which is 4.7% is the cost of the new debt, is sorry, is not able to compensate for the rise in equity. Okay, in fact, the new bond is going to cost us more than the old bonds, the YTM, right? So we will highlight all of these that there are after the new issue of the bonds, the WACC has marginally increased despite the new funding being done by uh, debt, okay, which essentially shows that the cost of equity has risen to a great extent. Then you can explain why the cost of equity has risen. Cost of equity has risen because financial risk has increased, and maybe the new business. Okay, so if you see how much are we earning, we are earning a 10% on the new business, and on the old business we were earning 24. So 24 on a base of 150. Okay, currently we are doing 10 million. Sorry, how much was it? Additional earning is 10%. Okay, and here we are making $24 million. Where did we go? Yeah, this is 10% is the return that we are making over here. Over here, we were making a return of 24 divided by, okay, 16% returns is what we are making. Okay, which means that the new business is not giving as much returns. There is more business risk. For that additional risk, we are not being compensated like in terms of returns. So cost of equity, basically, overall cost of equity has gone up, right? So this we can highlight. So cost of equity has, sorry, from 12% to 15.1%. So cost of equity has gone up, due to which the cheapness of debt is not able to compensate it. And cost of equity has gone up because of higher financial risk plus higher uh, business risk. Okay. So that we can say. So this is the overall impact on WACC. You can write a paragraph on that. Now the assumptions that we are making in order to do all these calculations. Now the assumptions we are making is that we make these sort of returns. Like we are assuming that so despite competition and everything, there was a statement that despite competition, we are assuming that we will pull it off. So that is an assumption. We can't for sure, we can't be sure because it's a highly competitive market, is what's mentioned somewhere. Okay, so that is one assumption that we are going to be successful. Second assumption we made is right over here. So the CAPM itself is based on assumptions. Okay, CAPM is just an estimate of cost of equity on which WACC is being, see, cost of debt we have given. Okay, but cost of equity is an estimate, right? The beta is an estimate, the equity risk premium, everything is an estimate. Only risk free premium we may know. And that too, we don't know. Risk free rate may change in the future. Okay. So CAPM, um, we have used CAPM for equity returns and it has its own limitations. Also, we have used in the new business, we have used asset beta and we have done a weighted average of asset beta. So we have taken the asset beta of another company. Proxy beta is used. So, in fact, if you remember the first mock that we did, or first day three, I guess, okay, over there also we had used this similar line that the asset beta may not necessarily properly reflect the business risk of our business. It is just the average, or it is just the business risk of some other company or the industry. It's not necessary that it is same for us, right? But we are assuming, in order to do this calculation, we are assuming the asset beta of another company. We are assuming that the risks are also in proportion of the investments, okay, or the contribution. So we, if you remember, we did like 60 divided by 210 will be the percentage of it. So yeah, 29% and 71%. We assume this. Okay, it is given over here, right? Which may not necessarily be the case. Another assumption we made, if you remember, is the bond price. I had pointed that assumption at that time only. So bond prices will get impacted. So you have to go through each and every appendix and see what all assumptions you are making and write one paragraph for each assumptions that you have taken. Now the next one, they have explicitly asked us what is the impact, or what would, how would equity shareholders and bondholders take this whole thing. Okay, so equity holders, now if you see that from 12.1 to 15%, okay, so they basically feel that the risk has increased. Okay, they are demanding now 15%, but however, the returns are much lesser. If you just see, where did we? Yeah, 10 and 16%. Okay, so the returns that we were making earlier, where see, these figures you could have just got from the question. You need not even do this entire calculation over here, because we knew what additional returns we are making and we knew what is the return before investing in it. So they also know that the return in this new investment is not as high as the existing business. So why even do it? Okay, is it proper to do it? And what is the return? 10%. And in order to earn this 10%, what are we doing? We are issuing a bond of 7.5%. Is it? This new bonds we are issuing, the coupon is 7.5%. So the returns, the additional returns that they are getting is very less. Okay. So they may not be very happy with it. Then, so one aspect is the return aspect of the new project. The other aspect is the risk that they are facing, financial risk, because more debt has come into play. Okay. So they are afraid that will there be money left for dividends, because consistently dividends were paid. After this new debt coming into place and returns dropping overall, um, will they get uh, decent, or will they maintain the same dividend levels? Okay, that's another concern. So returns are reducing, the risk is increasing. Normally, higher the risk, higher the return. Here, higher risk, lower return. So that is a concern for them. So you can write one paragraph on return, one paragraph on the increase in cost, both business cost, not cost, but risk, business risk and financial risk. Okay. Then, other than the financials, you can say that uh, what else you can say? So the bonds, new bonds are issued. Now, already we know that the old bonds are to mature after 3 years. Now, new bonds are to mature after 4 years. How are we going to pay for these bonds? Do we have any plan? How are we going to finance this bond? Liquidity concerns, all of that they will question. And also, once new bonds are issued, okay, let's see the new cap rate structure. Well, all right. It is 55% and balance is bond. But still, they may question that are there any covenants being, uh, like as in any terms and conditions being issued by the new bonds? Okay, they will need permission for giving dividends for new projects of the bondholders first. Okay, so depending if there are such covenants, so we can even highlight that there may be covenants on additional debt. Okay, and repayment is there. And so what is happening is overall risk of the company is changing. All right, it is becoming more riskier. Cost of equity is increasing, business risk and uh, your what do you say, financial risk is increasing. So existing shareholders who are not okay with such high risk may take an exit. Okay. However, if there is another class of investors who are riskier, they may enter. So there could be some changes in the share price as well. So this is like an overall impact of equity, right? Then bondholders. Now, existing bondholders are only concerned that how are they going to get their money on time, right? Is it existing bondholders or all bondholders? Is a requirement. Bondholders, okay, just bondholders. So yeah, bondholders, they are just concerned if they are going to get their money on time or not. Whether taking that additional bond and taking this new project, okay, investments are involved, the returns are not that much. Okay, or Obviously, it is more than the cost of debt or the coupon of that needs to be paid. But still, their main thing is, can you pay me interest on time? And secondly, do I get my principal back on time? They would want some sort of plan that how does the company plan on repaying the bonds after 3 years, and then immediately 1 year later, okay, more bonds need to be redeemed, right? So that's for the bondholder. And finally, a conclusion. So in conclusion, we can write, assuming a strong business case can be made for the investment and estimates are robust. So we are assuming that yes, we can, because the CEO wants to do this. So assuming that a strong case can be made for the investment and estimates are robust, Kingdom may be able to justify financing it solely by debt and claim the increase in financial risk is within acceptable level. Because see, to be honest, the debt to equity is 1:1 if you saw there. Okay, almost 1:1. In fact, equity is still more, 55% and 45%. All right. So it may be in acceptable levels. However, we need information of the industry average. We can't comment otherwise. However, before committing to future debt, Kingdom must also provide a clear plan for repayment of both the current and new bonds, or offer sufficient assurance that it will be able to refinance its debt when it's due for repayment. Okay, so this is the overall conclusion. That even if you are able to, assuming that you are able to justify that the business should be done, and assuming that all your estimates are done properly, they are accurate or not accurate, but to a great degree done with caution, okay, or is conservative maybe, or is proper, whatever, we are able to justify that debt should be the, because see, if more additional, if not debt, then additional equity, if additional equity is issued, okay, then cost of equity will go even more up, so WACC will go even more up. All right. So yeah, so we can justify because it is in the acceptable levels, right? So this is our final conclusion. So I hope this whole conclusion, everything is clear. Okay, let me see. We have another 45 minutes with us. Okay, let's do the second question, right? Um, okay, let's just take one quick 5 minutes break and come back and with a fresh mind start with this fresh question. All right, a quick 5 minutes break. All right, welcome back. Wait, is the audio proper? Yeah. Okay, net proper. Okay. Uh, so yeah, we have around 45 minutes left. Know how much? Yeah. Uh, okay. So these were all the instruction. The following exhibit available on the left-hand side of the screen provides information relevant to the question. So Colvin Company project information and discounting rate. The information should be used to answer questions requirement within your chosen response option. Evaluate the suitability of investment proposal in Canvia, including the impact of the country risk premium on net present value of the project, and discuss the validity of the chief executive's reason for adjusting the discounting rate in appraising the project in Canvia. Professional marks, 5 marks. Colvin Company is based on, so we have to basically find the present value, right? The net present value. Colvin Company is based in the Eurozone region and was established 10 years ago to manufacture competition standard bicycles for professional road racers. When the company obtained a listing 5 years ago, the founder retained a small minority shareholding. The remaining shares are held by a number of institutional investors. All right. So it's based in the Eurozone region, making cycles and got listed. And right now, the original promoters have a small minority shareholding, and balance is majorly held by institutional investors. And the board recently decided to expand the range of models and to look for new growth opportunities abroad while manufacturing currently restricted while manufacturing is currently restricted to the eurozone. The board of directors has identified Canvia as a key growth market and is considering a potential investment project to manufacture and sell a new model there. This would involve establishing a subsidiary in Canvia. All right, so they are thinking of starting a new subsidiary in Canvia. The currency in Canvia is Canvian lira, and the current exchange rate is CL 9.91 CL per euro. So 1 euro is equal to 9.91 CL. The annual rate of inflation in Canvia is expected to remain at 10% throughout the 4-year duration of the project. The finance director estimates our inflation, okay, annual inflation is given 10%. The financial director estimates the project's sales volume, inflation adjusted pre-tax contribution and fixed costs as follows. So our sales volume, everything is given over here. So in fact, we can just copy paste this whole thing. Okay. Right. And we can add a year zero also. Right. The project will require an immediate investment of CL $75 million. So this is our initial investment in land and building, and 700 million in plant and machinery. So 700 plus 75, so 775 will be our total initial investment. Tax allowable depreciation is applicable on plant and machinery on straight line basis at an annual rate of 25% on cost. So flat, it's on SLM basis, so it's a flat 25%. Coven Company's finance director believes that the plant and machinery will have a zero residual value at the end of 4 years. The land and building will be disposed of at the end of the project, and the tax exempt value is expected to increase at an annual rate of 30% throughout the 4-year life of investment. So, what is the land and building will be disposed of, and the tax exempt value is expected to increase at an annual rate of 30% throughout. So, the land is expected to grow at the rate of 30%. The project will also require an immediate investment in working capital of 25 million, and the incremental working capitals are given over here. Working capital will be released back in full at the end of the project. Keep that in mind. Coven has a policy of extracting remittable cash flows as dividends at the earliest possible opportunities. Okay, so you whatever returns you will make, everything will be taken out as dividends. All components for the new bicycle will be produced or purchased in Canvia except for a gearing system component, which will be manufactured by Coven company in the Eurozone. The cost of acquiring this component from the Eurozone is already included in the pre-tax contribution estimates based on transfer price of 10 euros per component. The finance director estimates a manufacturing cost of £2 per component. Both the transfer price and the manufacturing costs are expected to increase in line with Eurozone inflation of 4% in 2 years, and then after that, 2% in year 3 and 4. Okay. Corporate tax is payable annually at 25%, and companies are allowed to carry losses forward to offset against future trading profits. So, one interesting thing is they are allowed to carry forward their losses, okay, and offset any future profits. So Coven company pays corporate tax in its home country at an annual rate of 20%. Taxes are payable in both countries in the year. So this is like an international investment appraisal. Bilateral tax treaty exists between two countries which permits the offset of overseas tax against any domestic tax liability incurred. Okay, so our tax adjustments. Exhibit 3, the board proposes financing the project with a mix of equity and debt in such a way that existing capital structure remains unchanged. For the purpose of this project, the chief executive believes that Coven's weighted average cost of capital is 13%, should be adjusted to include a country risk premium on basis of Canvia is a developing economy and appears to be economically less stable than the Eurozone countries. She made this decision after consulting a country risk index, okay, which compares the standard deviation of market returns in various countries. So actually our WACC is 13%, but the CEO is of the opinion that this should be risk adjusted because Canvia is a much riskier market. Additional or rather country. Additional factors taken into consideration includes foreign risk, the fact that there may be frequent changes of government and hence economic policies in Canvia. You have therefore been asked to discount at 16% appraisal to appraise this investment project. So normal discounting is 13%, but we have been asked to adjust for that risk and discount at 16%. Okay. So first, let's find out our cash flows, relevant cash flows. So we have sales volume over here. This is not a cash flow per se, but okay, maybe it's used later. We will just keep it over here. Pre-tax contribution is available. So directly we are given, what do you say? Sales minus variable cost and fixed cost is given. So I think on this we can calculate tax. Okay, there was something about depreciation, so we need to add the tax allowable depreciation. So TAD, because that will have impact on taxes. Okay, let me just so show that this is the actual units that we are taking. These are just units. These are all in CLM. Okay, so CL million, sorry. All these figures are in CL million, even year 0. Okay, so yeah. What is our tax allowable depreciation? So 75 plus 700 into 25%. It's straight line method. Okay, so is equal to 700 plus 75 into 0.25, right? So was it 75 plus 70 on an SLM of 25%? 700 into 75. What the rate? The net is unstable. We'll just wait for some time. I'll just change the screen till then. Okay, I hope it's stable. Yeah, 308. Okay, I think it should be. Let me just check. Um, yeah, it seems proper. All right. So, what we were saying, yeah, so 25% is plant and machinery. The tax allowable depreciation on plant and machinery on SLM basis at an annual rate of 25%. Okay, so plant and machinery uh, is 25%. So plant and machinery is 700. So on 700, we have to do 25%, and then wait, tax allowable depreciation is on a SLM at an annual rate of 25. Director believes that the plant and machinery will have a zero residual value at the end of 4 years. The land and building will be disposed of at the end of the project, and their tax exempt is. So it is on SLM basis 4 years. We can either do. Okay. Wait a minute. Again, the net is gone. Oh, wait. Okay, I think it's back. I hope it's stable now. Okay. Wait, let me just check. Yeah, it seems 2000 kbps. Okay. Uh, where were we? So yeah, depreciation. Okay, one mistake I made was the depreciation is only on plant and machinery, not the entire thing. Land and building is in fact appreciating. So I took on entire thing 25%. Only on uh, that 700 million are we going to do 25%. Okay. So it's SLM, so it's going to be the same. Now we can find out our profits or losses. Or okay, so profits will be our contributions less fixed costs less tax allowable depreciation. Okay. right? So these are our profits. So if you see over here, we have a loss. So we can carry it forward. Loss carried forward. Okay. So we can carry forward losses. So we are going to carry forward whatever loss we have and bring it over here the next year. Right. So our net taxable profit will be, so since we made a loss, we are taking that loss to the next year. And in this year, we are saying that there is no loss, as in there's zero profit. Okay, so tax that you will pay, tax at 25%. Now this into 25% obviously will be zero. Okay, now these are not dollars. Okay, they are CL million, lira, Canadian lira. All right, now tax is reduced. Okay, so we'll find out our, or we can just add back all the things that we did to reduce. So see, understand this, that this is non-cash, and understand taxable depreciation is reduced. Okay, this is reduced, then this is reduced, or this is now from here we are removing it. Okay, and there we are adding it. So whatever, so I'll just keep it as is. But this is also non-cash. It's not like we are taking. See, you have an outflow of 25 million. You are not taking it and making it positive or anything. So it's not a cash flow. Okay. So whatever our non-cash flow will get the opposite effect. So add back PAD. Okay, and loss carried forward will be readjusted. Okay. This also we can say this is. We are adding back. Just writing this for your information. So we are adding back TAD. Why? Because it is non-cash. Okay, keep these adjustments. So TAD adjustment, I'm sure you would know, but the loss carried forward, maybe not all of you know. Some of you, my students, would know. Okay, so this gets added back, and this also will get added back. So the signs will basically get reversed. Okay, just write it as is. Right? And then we can come up with our net cash flow. Taxes are paid, everything is done. So net cash flow will be now this less any taxes, sorry, it is equal to sum of, no, we'll just take individual. So our profits, okay, on that we will, wait a minute. What am I taking? Net taxable profit. Yeah, here it is. So, zero, I kept skipping it. So our taxable profits minus the tax Then we have to add back depreciation and add back the loss which we are carrying forward. So this will be our, wait, this was actually minus. So and then we can just extend this. All right. So this will be our cash flows, net cash flows. Let me just bold it so that it's clear what we are doing. Yeah. Okay. Now, initial investment. So initially we are investing 775 million. Okay. And this gets, this basically uh, the land grows, it appreciates. Okay. So how much was the land? I think 75 million was the land, 75 million land and 30% over a 4-year period. Okay. So it's compounding 75 into 1 plus 30% raised to 4 years. Okay. We'll just make it 2 decimal place. Right. So this is our initial investment and the land is being sold at the end of the year. Now in our working capital investments. Okay. Now let's see how much are we investing. So we have this year 0, year 1, year 2, year 3. Okay, year 4, there is nothing. Now, remember that everything gets released at the very end. Okay, or everything gets released. So that means you have invested 25 million, then 2.5 million, 2.8 million, and 3. These are all incremental. Okay, this is your incremental working capital requirements. Okay, so whatever incremental, if you want, let's just okay, this is incremental working capital requirement. So investment, we are going to invest 25 million because that is required. Okay, now this is incremental, so additional 2.5 we have to add. Okay, so it's going to be the same. So I just took it directly. If you want to understand it, it's nothing that we are just adding, and then at the very end, it will release off. Okay, in year 4, there is nothing. Okay, so at the end of the year, what's going to happen is this gets released. Okay, so actually, let me just label it working note 1, calculating working capital investment. Right? Not really required. You could do it directly, but okay, just to explain, I have done that. All right, so 33. So let's find out our net cash flows before we do all that foreign exchange adjustments. Okay, so our cash flows will be, both of these are outflows, right? And then these are our final figures. Okay, Just a moment. Oh, I didn't take the above value. Right? These are our final cash flows. All these net cash flows. Okay. Now, what else we need to do? We need to take care of the foreign exchange, all the transaction and the foreign taxes and everything. Okay. So, firstly, we need to determine what will be the exchange rate, right? So this is wait, just right. Okay. The exchange rate. Okay. The exchange rate. Now, for the exchange rate, what information they have given? Yeah. They have given the current exchange rate to be 1 euro is equal to 9.91, right? So in year zero, so this is 9.91. Okay. Now in year one, if we have to, this okay. If we want to find the exchange rate going ahead, we can use the IRPT or PPPT. Let's see the formulas. So yeah, we can use our interest rate purchasing power parity theory. Sorry, IRPT. No, sorry, this is PPPT, purchasing power parity, not IRPT. Okay. So this is inflation rate of counter currency and inflation rate of base currency. So which is our base currency? We are a Eurozone based company. Okay. That new country, what is it? Canvia is our counter currency. So base currency inflation rate is given to us. Base currency inflation rate is annual inflation of 4% initially, and then it becomes 2% in the year 3 and year 4. So first 2 years 4%, okay, and 2% next 2 years. And then what is the inflation rate of the counter currency? 10% fixed, right? So we can forecast it that into 1.1. Okay. So if you see the formula, it is the current spot rate into 1 plus HC, that is interest rates of or inflation of counter currency. So you can just directly write 1.1, or you can write it as this 1 plus 10% divided by 1 plus our base currency initially is 4%. Okay, this whole thing, and let me put it in brackets as 1 unit. All right. So 10.48 Now we can just wait. Sorry. We can just copy the same formula and let's just check whether it's properly done. Yes. Now this is not 4%. This will be 2%. So okay, 1 plus 2%. Right? So this will be our exchange rate. If you want, you can just mention HC. This is just for your understanding. HB or inflation in euro, which is nothing but your HB. In Canvia. Okay, so this was 10%, right? And here it was 4%, 4% and then 2% each. Okay, so we have our exchange rate. Now, what else they have given us? They have given us that certain component is purchased. So the pre-tax contribution estimates based on transfer price of 10 euros per component. The finance director estimates the manufacturing cost is $2 per component. Okay. Both the transfer price and manufacturing costs are expected to increase in line. So our contribution is basically increasing. Okay. So this $10 per component, sorry, $10 and $2 per component keeps changing as per inflation. Okay, so let's solve that. So next working note. It is component contribution in euros because that is what we are going to incur in euro terms. All right. So our years. Now we'll need for our cash flows, we'll need the sales figure. So this is our sales volume. Okay. So our sales volume. Then I said contribution. No, price based on transfer price of 10 per component and the cost is 2 per component. So this is not contribution, this is the price or transfer price. That is the selling price per unit. Okay, this 10 and cost per unit was £2. Okay, therefore contribution per unit will be £8. Okay. These are all in euro. Okay. If you want, you can write it over here. Right. So we have our contributions over here. Now it is inflating. So inflation in euro. These are our inflation. Okay. So inflated contribution per unit equal to this into 1 plus R, okay, raised to 1. Okay. So our inflated price is this much. Therefore, our total contribution, uh, the inflated contribution into sales volume. All right. Now over here, everything is in million terms. Okay. All our cash flows are in million terms. So we'll also write these in million terms. So divided by a million. So $0.9 million. Okay. Now, similarly, we have inflated. So it's year 2 inflation and then 1.1. Now, this is what you normally do. But what is going to happen now is what's going to happen now is the inflation rate is changing to 2%. So we cannot take this into 2% raised to 3. We'll get the wrong answer. Okay, see, if it was 4%, we could have continued because this is what we have done over here, raised to 2. Okay, so what we have to do now is, or you can modify this as saying that what is my previous price on this, I'll further grow 1 plus 4%. Okay, answer is same. Now it will factor in those other two also. Okay, what is happening is previously the contribution was 8, it's growing at 4%, it becomes 8.3. On 8.3, it's further growing 4%. On 8.7, it's further growing 2%. On 8.8, it's further growing by 2%. All right. See, if the interest rates were, inflation rates were constant 4%, then you could have done 8 into 4% raised to 1, 8 into 4% raised to 2, 8 into 2% raised to 3, raised to 4, not 2%, sorry, 4%, 4%, 4%. That's what we normally do for inflation. Okay. Compounding is basically taking the previous cash flow and then interest on interest. Okay. So this is already with growth. So growth on further growth. All right. I hope this is clear. Keep this in mind. I'll, in fact, just make this bold so that you understand. Okay. So these are our final total contributions in euros. All right. Clear? And now we can accordingly, because this was the only euro transaction. So now we can accordingly convert our cash flows and proceed with the solution. Okay. So now we can write our net present value. So net NPV using, what was the discounting rate they gave? There were two discounting rates. At the end, I think they had given it 16% and 13%. Okay, so let's use both. We'll do 16% first. 16% discounting rate. Okay, and all figures are in euro million. Okay, years, right? Now we have to calculate our cash flow, but we have to convert it. All right. So cash flow. No, before this, we have to. Wait, there was that tax treaty which we haven't done, and even the contribution part. Okay. Cash flows in euro million. Okay. You can copy paste our years. Right. We could have done it here also, no problem. Anyways, just better presentation. So our exchange rate is, as per our working note number 2, okay, will be year 0, year 0 also we have. Okay, we have our exchange rate with us. Okay, then we can say our cash flows will be. So firstly, our initial investment will be okay. These are all in euros. 80.7 million euros. That's our, sorry, this is our total investment. Okay. Then our Our remittable cash flows that we are bringing immediately. Okay. Right. Then, so after doing business from the other country, what was it? Canvia. Okay. We are making these sort of cash flows. This is the investment that we are doing in Canadian lira. Right. Now we are converting all of that in euros because reporting is done in euros. Right. So convertible cash flows, no, we are remitting these cash flows immediately. So upon conversion, they become 14 million euros, 18.4 million euros, and 25.8 and 58.7 million euros. Our component contribution, because one this is one cost that we are experiencing over here. So this is working note 3, component contribution. So zero point 0.9. Okay. So this is our component contribution, and tax on net contribution. So what is the tax? What was the information about tax given? Board proposes to finance economic less. No, this is about the discounting. Yeah. Corporate tax in Canada is payable annually at 25%, and companies are allowed to carry losses forward. Coven company pays a corporate tax in its home country at an annual tax of 20%. Okay. So only 20% tax needs to be paid. See, in Canada, we have already paid 25%. Now there is a bilateral tax treaty, which means that if I've already paid 25% in Canada, I need not pay anything on my remittance because it is more than 20%. Had this been 15%, then we would pay 5% extra on our remittance. Okay. So it is only the contribution part which will be taxed at 20%. So 20% on this will be our tax. Remember, tax is an outflow. So okay. And we can find out our total cash flow. Net cash flows in euro million. This is an outflow. This is an inflow of cash. Contribution is also an inflow. And tax is a payment outflow. Right? So these are our total cash flows. Now, in fact, no need to even do this. We can directly just write our NPVs. Okay, so we'll just cancel this whole thing. So NPV at 16%, okay, is equal to NPV, bracket open 16%. Remember, we will take cash flows only from year 1, okay, future cash flows, and then adjust for the initial investment. All right, so it is a negative 3.3 million. and NPV at 13%. That is if we do not adjust it. 13%. This is 16%. Okay. So this is a positive 2.8 million. These are our two NPVs. So in our conclusion, we can write that, see, if we are to discount, now why is this? This is country risk adjusted. Is it country risk adjusted? Okay. With country risk premium. This is without country risk premium. Okay. So if we discount it without the country risk premium, only then is the project favorable. Otherwise, it is not. Again, these are not dollars, these are euros, very important, and million. Okay. So only when we are discounting with the country risk premium, uh, which we ideally should, because there are risks associated to it. Uh, so ideally we shouldn't be doing, because there is country risk. So that we can write it in our conclusion or comment or advice or whatever is being asked. Okay. What is the next question? I think we will take a hard stop over here. Discuss the validity of chief executive's reason for adjusting the discount rate using appraising the project in Canvia. So we have to say why is there a need for that discounting rate. So she has already given the reasons. Okay, why do we need to adjust discount rates? So there is exchange fluctuation, there is change in government. So all these things relate to additional risk. Us doing the business in Eurozone, so there is a country risk associated that when you are adjusting, that country risk gets uh, as in is taken into consideration. So you need to elaborate and write on that. Okay. The next question is actually on your hedging. We have already done a type of hedging yesterday. So it's very similar. It's pretty straightforward. So we won't do it. Okay. We are anyways above our time. So we'll take a hard stop over here. I hope these two questions are clear. Okay, section A and section B, one question. And if you haven't seen the previous videos, please watch them, see how the solution is done. If there are any doubts, any questions, please leave it in the comment box. We are always happy to help. And all the very best for your exam. I know you all are going to do great, right? Thank you so